What's up, everybody? My name is Joe Brown, and this is Heresy Financial. Today, I'm going to share two charts with you that will absolutely blow your mind. Unless, of course, you follow me on Twitter, in which case you've seen one of them already. But we are going to be talking about today why, if you have a margin balance at all, now might be the perfect time to get rid of it. Ready? Let's dive in. All right, first things first. You know that I rarely on this channel say that you should do X, Y, or Z. I hardly ever say you should buy something or you should sell something. This is one of those rare exceptions where I'm giving out a warning to everybody. This is pretty dangerous if you are in this boat. So what boat is that? Take a look at this chart. This is the total margin level of all brokerage accounts. And you can see here that it has absolutely gone crazy over the last couple of quarters. We can see that every time margin balances hit a peak, they come crashing back down. It happened during the dot-com bubble burst, happened in 2007, it also happened in 2015. But this latest spike puts all those previous spikes to absolute shame. What this essentially means is that everybody is in the same trade. It doesn't matter what stocks you own, it doesn't matter what ETFs you own. Everybody's in the same trade here. Because the reality is, when liquidity events happen, you don't sell what you want to sell, you sell what you can sell. All we have to do is look at a very recent example, March of 2020, when everybody was getting margin called. Stocks went down, gold went down, crypto went down. It doesn't matter. When everybody's getting margin called and everybody has to start selling, you're going to sell what you can, which means a lot of times you're going to sell the things that are doing better so that you can get more bang for your buck. Now, with margin balances as high as they are right now, this is a very crowded trade, meaning owning something, especially with leverage, is a very crowded trade. And one thing we know about crowded trades is that you don't want to be a part of them, number one, and number two, you want to be the first one out the door. We've seen time and time again how crowded trades lead to the pendulum swinging viciously the other direction. In 1998, Long-Term Capital Management was a hedge fund that almost took out the financial system. They had so much leverage on their trades that the things that they owned with a lot of leverage and the things that they were short with a lot of leverage started moving against them, and they had to start liquidating. Bear Stearns started to call the margin on them. They said, hey, you need to start closing out and paying us back. You haven't had the proper equity levels in a while. You need to pay us back. So everything that they owned, they started to sell. Everything that they were short, they started to buy to close. What does that do to the remaining positions? It makes the losses worse because you're such a large player when there's so much, when that's a crowded trade. You start to liquidate things that you're long, that's going to start putting selling pressure on, which makes everything else that you still own far worse. Fast forward almost 10 years and everybody was into mortgage-backed securities. That was a very crowded trade. And once everybody started to try and get out of them, it viciously swung the other way. And with the stock market having some bad days over the last couple of weeks, we could be very close to one or two more bad days prompting margin calls to begin. And once that starts, things can unwind fast. Just for some more historical perspective on this, let's look at the second chart. This chart was posted by @NorthmanTrader on Twitter from advisorperspectives.com, and it shows some historical context as to what's going on here with margin balances. That middle line there with green above and red below shows the net market positions. If it's green above, that means net cash positive. If it's red below, that means net margin position. There's a negative cash position on net. We can see what the dot-com bubble looked like at its peak before it unwound. And really over the last 10 years or so, margin balances have grown worse and worse. Now the blue line you can see here is the S&P 500, and you can see the white spike or drop in margin balance that happened at the beginning of 2020. That's what happens. That's what this margin balance does to the market when it has to start getting drawn down. When everybody's closing out their positions because their broker has a margin call on them, they don't have enough equity to support the debt in their account, so they have to sell what they have. That drives the market down very fast. Now this chart obviously doesn't go back this far, but margin calls were one of the things that sparked the beginning of the Great Depression, when everybody was getting margin called because they were leveraged up to the hilt buying these stocks because it looked like a perpetual money machine. And so you're just going to borrow and buy more. And the moment that debt starts getting called, everybody has to sell to pay that back. Prices dropping, that means less equity. You got more selling, paying off that back, and it's just a downward spiral. Now, to be clear, I want to make something clear. I don't think the market volatility that is happening right now is the beginning of a massive unwind of all this leverage, all this margin debt in the stock market. And if it is, and I'm proven wrong here, it just means that the tantrum started before the taper even got going. So personally, I do think that we have one more big leg up from here, and this margin balance issue gets much worse. A lot more leverage enters the system before the big crash happens sometime, I think, next year as a result of Fed tightening. Now, at the end of the day, I'm not going to be able to time the top of this market, so I have no desire to ride this leverage wave up higher. On the other hand, if we don't have a melt up from here and it is just down, I don't want to have to try and time the bottom, so I am still long, I'm just hedged. Now, I want to be clear that when I say that leverage is very dangerous right now, I'm talking about callable debt like margin loans for the stock market. Other forms of leverage like mortgages that are fixed rate debt are fantastic hedges against the devaluation of currencies. So they're very different things. This video, I'm just talking about margin debt being leveraged in your stock brokerage account. And finally, if you would like to learn how to hedge or use advanced option strategies like iron condors and spreads to profit off of these crazy market times, check out my advanced option course linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.